The year 2026 is shaping up to be one of the toughest moments for first-time homebuyers in the United States. And it's not because of one single problem, it's because of a perfect storm of economic pressure, housing shortages, delayed consequences from 2020-2023, and new financial realities hitting all at once. To understand why 2026 could feel like a bad year for new buyers, you first need to zoom out and look at what's been happening since the pandemic. Between 2020 and 2022, mortgage rates reached historic lows, falling under 3% for millions of buyers. This created a massive wave of demand that the existing housing supply couldn't keep up with. When you mix intense demand with limited inventory, prices skyrocket. And that's exactly what happened. Even people who never planned to buy rushed into the market because it was suddenly now or never, driving values up faster than wages could keep pace. Then, starting in 2023, the Federal Reserve began raising interest rates repeatedly to fight inflation. Mortgage rates doubled, then almost tripled for many buyers. Suddenly, someone who could afford a $450,000 house at 3% interest could barely afford a $300,000 home at 7%. This shift locked millions of people out of the market. Fast forward to 2026, and you have an entire generation of first-time buyers facing the consequences of both the past and the present at the same time. One of the biggest pressures in 2026 is the lock-in effect. Millions of homeowners who refinanced at 2.5% or 3% interest simply refuse to sell their homes because switching to a 6% or 7% mortgage in today's market would double their monthly payment. This means fewer homes are being listed, inventory remains historically low, and first-time buyers are forced to compete for a tiny number of available properties. On top of that, the homes that do come onto the market are often older, need repairs, or are priced far higher than what the average American salary can support. Another issue building toward 2026 is delayed construction. During the pandemic, building materials became expensive, supply chains broke down, and millions of construction projects were delayed. Even when builders wanted to produce more homes, it was impossible or too unprofitable. Those delays ripple forward several years. That means many of the homes that were supposed to add supply by 2024 or 2025 will not be completed until later, or never at all. This keeps inventory tight. Meanwhile, Gen Z is hitting peak home buying age. Millions of young adults entering the market at the same time creates new demand in an already constrained housing environment. And unlike previous generations, young buyers are dealing with higher student loan debt, lower wage growth adjusted for inflation, and fewer affordable properties. Add to that high interest rates, and qualifying for a mortgage becomes the biggest obstacle of all. Even if someone finds a property they like, the monthly payment might simply be out of reach. Another factor making 2026 tough for first-time homebuyers is the wave of adjustable-rate mortgages, ARMs, resetting. Many buyers who took ARMs between 2020 and 2022, when rates were low, will face higher monthly payments when their rates reset in 2026. Some homeowners will struggle to afford the new payments, but instead of selling, many will refinance or rent out the property, keeping it off the market. This again reduces supply for new buyers. Combine that with inflation staying sticky in certain sectors like insurance and property taxes, and the cost of owning a home becomes heavier, even for people who already bought. These rising expenses spill into home prices as sellers try to pass higher ownership costs onto buyers. Another major but less obvious factor is institutional investors. Over the past few years, large corporations and investment groups have purchased tens of thousands of single-family homes, especially in states like Texas, Georgia, Arizona, Florida, and North Carolina. They convert these properties into rentals, which removes affordable homes from the market. First-time buyers end up competing not just with families or other individuals, but with billion-dollar companies paying in cash. This competition drives prices up and leaves ordinary buyers at a huge disadvantage. And by 2026, institutional ownership of single-family homes is projected to be even larger, which means even fewer entry-level homes will be available. Economic uncertainty in 2026 adds another layer of difficulty. If unemployment rises even slightly, lenders become stricter. That means higher credit score requirements, larger down payments, and tighter debt-to-income ratios. Even buyers who could qualify in 2024 or 2025 might find themselves rejected in 2026. And when lenders tighten up, fewer first-time buyers can enter the market. Another reason 2026 may feel like a bad year is psychological pressure. Many people who waited through the pandemic years plan to buy later, expecting the market to cool down. But when prices stay high, interest rates stay high, and the cost of living rises, that hope slowly fades. By 2026, millions may feel trapped, either continue renting at high prices or try to buy in a market that feels almost impossible. Rent prices also create pressure. As home affordability declines, more people continue renting, driving demand higher. Higher demand pushes rent upward, making it harder to save for a down payment. It becomes a cycle. Homes are too expensive to buy, rent is too expensive to save, and wages don't keep pace. Another long-term consequence arriving in 2026 is the shortage of affordable starter homes. Builders prefer constructing larger, more profitable homes rather than small entry-level ones. This trend started over a decade ago, and by 2026, the market for starter homes is historically small. For many first-time buyers, this means paying more for homes that are bigger than they want, older than they expected, or located farther from their job, family, or city center. The result is frustration, financial strain, and a feeling that the dream of homeownership is slipping away. But even if 2026 looks challenging, it's not hopeless. Some markets will cool. Inventory will slowly rise as conditions shift. The economy may stabilize, but the key reason 2026 appears difficult is because it represents the point where all the consequences of the last 6 years converge. Rising rates, limited inventory, delayed construction, population growth, inflation, institutional ownership, and stricter lending. It's not that 2026 is cursed. It's that the system has been building toward these challenges for a long time. Anyone looking to buy in 2026 will need patience, strategy, and realistic expectations, but also the understanding that the difficulty comes from complex factors shaping the entire country, not from personal failure. And while 2026 may be tough, housing markets always evolve, and the cycle will eventually shift again. Many people think the housing pressure will explosively hit in 2026 because of interest rates and mortgages, but another part of the story that almost nobody talks about is how insurance companies in the U.S. are quietly pulling back from high-risk areas. In states like California, Florida, and parts of Texas, major insurance companies have already stopped renewing policies or have raised premiums to record levels. By 2026, many first-time homeowners will be shocked to discover that their insurance bill might double or even triple, and without insurance they can't keep a mortgage. This means thousands of people could be forced to sell their homes suddenly, adding even more supply to a market already under pressure. When more people try to sell at the same time, prices start dropping fast, leaving new homeowners stuck with houses worth less than what they paid. Another element almost nobody mentions is the massive wave of property taxes that will reset in many counties. When home values skyrocketed during 2020-2022, many local governments delayed tax reassessments. But in 2026, these delayed increases will hit families all at once. A homeowner who used to pay $3,000 or $4,000 per year might suddenly owe double. For someone already stretched thin by higher mortgage payments, this extra financial hit could be enough to push them into default. And when defaults increase, banks tighten lending even more, making it harder for first-time buyers to enter the market. A third factor hidden in the background is that millions of American households used buy now, pay later services, credit cards, and personal loans to survive the inflation years. By 2026, a huge percentage of these debts will enter repayment peaks at the same time, reducing how much income homeowners can use to cover rising housing costs. Lenders use something called the debt-to-income ratio, and once your total monthly payments pass a certain limit, you become too risky. This means many people who think they'll refinance in 2026 will be denied because their debt has grown too much. Another problem building up quietly is aging home infrastructure. Houses built in the 70s, 80s, and early 90s are now hitting the age where roofs, plumbing, HVAC systems, and electrical work all need major upgrades. During the past few years, many people bought homes without inspections or waived repair demands because the competition was insane. In 2026, repairs that were ignored will suddenly become mandatory. A roof repair that used to cost $8,000 can now be $15,000 or more, and many first-time homeowners simply won't have the savings for that. When they try to borrow for repairs, banks will check their high interest rates and unstable incomes and deny the loan. This leaves them with a home that's losing value and repair bills they can't pay. Another underrated issue is zoning changes and stricter building codes coming in 2026 in several states. Some counties will require energy efficiency upgrades, new heating systems, or insulation improvements for older homes. These upgrades will raise the cost of maintaining a home by thousands of dollars. Buyers who stretched every dollar just to get a home won't be prepared for these new rules. There's also the political pressure. In 2026, many federal housing programs face renewal or expiration. If certain subsidies disappear or certain protections end, many low-income and first-time buyers will lose support overnight. Combine that with global economic uncertainty, especially rising energy prices and supply chain instability, and the cost of basic home utilities could spike again. When electricity, gas, and water bills rise at the same time as mortgage costs, many households will feel financially trapped. Another thing rarely discussed is investor liquidation. Large investment companies that bought thousands of homes during the pandemic are preparing exit strategies for 2026-2027. They bought homes cheaply, rented them for a few years, and now want to sell at the peak. But if they all decide to sell around the same time, the sudden flood of homes on the market could crush prices in certain areas. First-time homeowners who bought at the top will be the most exposed to losing equity. 2026 is also the year when millions of student loan borrowers might hit new repayment phases with higher monthly amounts. When those payments restart or increase, entire families will see their budgets tighten even more. Higher education debt combined with mortgage pressure is a dangerous mix for new homeowners, and most people don't see it coming. The last thing almost nobody talks about is demographic change. Millennials, who drove most of the demand, are hitting their peak home buying years, but Gen Z is much smaller and has lower income. This means the number of buyers in the market after 2026 could decrease sharply. When the next wave of first-time buyers is too small or too broke to buy homes at high prices, demand drops and prices fall. New homeowners who bought recently will be stuck with expensive mortgages in a market where fewer people want to buy. All of these factors together, insurance withdrawal, property tax shocks, hidden homeowner repair costs, investor sell-offs, tighter credit rules, rising utility bills, and demographic decline, create a perfect storm that will hit first-time American homeowners very hard in 2026. The people who stretch their finances to the limit just to get into the market will feel the pressure the most, and many will face decisions they never expected: sell, default, or hold on while losing money every month. Thanks for watching. Don't forget to subscribe, that helps us a lot.